What's up? Yo, yo, yo. Just waiting for some people to join. Hopefully I'm using my good mic. Yes. Okay, good microphone. Let's see if anyone will join. But today, okay, Travis is coming. Perfect. What's up, Travis? Thank you for joining us always.
What's up, bro?
Stuff. Pin this, share this, share, okay. Then this, and basically that's it. So let's see, Gabriel cannot participate today. Diego is not answering. Thankful that at least you joined. So looks like again we have our individual session for today. Today, as you can see, as you can remember from basically Instagram, whenever I announced the topic, today we're going to talk about how to find good investments. Today, I think it's a very nice, very interesting, very important topic, because finally today we're not going to speak about like any numbers or anything like this, formulas, calculations, like nothing like this. Basically today is just like part of the mindset, like how to find good investments. Like, of course, you can know all the types of fundamental analysis, you can know all the ratios, all 30 of them or whatever I'm using, like 29, I don't know. You can know all this, but if you do not have good companies to select from, like it's basically useless. Like you can know how to drive a car, but if you don't have a car, like what's the point of you knowing how to drive a car? Same idea here. In order to basically do good investments, first of all, you need to find such companies. Then you need to build a watch list out of these companies. And basically, whatever I'm sharing every single month, I'm adding a couple of companies every single month. I think this time is 190. And basically, that's it. Like, if you see that one of your companies in your portfolio is underperforming, then just basically compare it from another company from my watch list, go to the same sector, because if you remember, if you're investing, you need to have diversification across different sectors, like one from industrials, one from materials, one from financials, one from this, one from that, like as better diversification as possible, like as many different sectors as possible, and try to keep the ratios, try to keep the percentage of each sector in your portfolio approximately at the same levels. So like I said, if I have like 14 companies, I usually try to keep every sector for around, every company for around 7%, which is obviously 7 times 14 is 98%. So you get the idea. So every company has equal weight in my portfolio. And the purpose of my watch list, why I'm uploading it, I don't know if you've seen it or not, every single company on my watch list, it is separated by sectors and in industries. So basically, like I was saying, if you see that one of your companies in, let's say, so basic materials sectors is underperforming, or fundamentals getting bad 2 quarters in a row, you just simply go to my watch list, or if you have your very own watch list, you select just basic materials sectors companies, and I don't remember, I have like 5, 6, or 7 of them, and that's it. You have 5 or 6 different equivalents, 5, 6 different alternatives to replace this company if you need to replace it, let's say so. And basically, that's how all investments start. You have the company, you analyze it, you compare it with competitors, you select the best company at this moment from each sector, you invest in it, hold it, keep track of this every single month. You see if anything changed, and if everything is good, just keep holding them, buy more, dollar cost averaging, and all this kind of stuff. Okay, let's see. No one joined, so it's still just the two of us. And basically, you already know the drill. I'm doing the presentation. In between sections, I'm minimizing the window so that if you have any questions or if anyone is joining, I can basically allow people in the room, or I can answer questions. same stuff like every day, every week, I mean. Okay, so the topics for today, like maybe you've seen already in Instagram, I send them. For today's a little bit longer maybe presentation than usual, but like I said, very important. First of all, what are good investments? Because you might be surprised, different investor mindsets, different investing strategies, they have their own vision of what is a good investment. Then we'll talk about Dow Jones Industrial Average and Dividend Aristocrats, then the dogs of the Dow, small, medium, and unpopular company. And then we'll talk about why you should not follow Wall Street, basically recommendations. Then we'll talk about recovering companies, and finally, where to get financial data from. I'm sure you already know where to get from, but since I'm recording this, since Gabriel is going to be watching this, what's up, Gabriel? Thank you for watching. Like for him, it will be very important, and for other people who are watching on YouTube, if there's anyone watching on YouTube. Okay. And the first one is, don't know, okay. Okay, yes, the first one is basically what are good investments? You can ask many different investors, traders, and they will most likely give you their own versions of good investments. So like I was saying, different investors have different understanding of what can be considered as a good investment. For example, growth investors, they prefer maximum return. They are ready for high risk. So they are ready to trade being risky for the potential of bigger than average returns. So basically, self-explanatory, you just invest in, I don't know, like small, medium companies, you invest in, I don't know, technological sector, you invest in all this like electro cars, blah, 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 this and that, Tesla, all the way to $1 million per share. You get the idea. The next one is value investors, which is more or less my mindset. I am being, I would say, maybe 80% value investor, or maybe like 70, 80% value investor, and 20, 30% I'm a growth investor, because my investment horizons are very, very long, 30 plus years at least, I would say. So for this reason, I can afford taking additional risk. I'm not sure if I said it in the previous presentation, but maybe you already heard it, Travis. I'm just saying it once again for Gabriel, since he's going to be watching this presentation in recording. So the longer you're planning to invest, the higher your risk tolerance can be, which basically means the longer you're planning to invest, the more risky investments you can make. Just don't go crazy. Don't invest in IPO and penny stocks and stuff like this without obviously further analysis, your very own analysis. So don't go too crazy. Don't be too risky. But if you're investing for like 30 years, you have time, just in case if something goes horribly wrong, you still have time to recover, let's say so. And something will go wrong no matter what. If you're investing in risky companies, even if you're investing in, I don't know, total stock market, anything can happen. Like stocks can lose 20% in 1 week. So like anything can happen. No matter where you're investing, anything bad can happen. It's just that the riskier stocks are, the more chances of such things happening. And the more conservative stocks are, the least chance of those things happening, which basically means that the longer you are planning to invest, the more risky you can be, because you still have time to recover. But the closer you are getting to the end of your investing journey, the closer you are getting to your retirement, then you need to switch from risky investments to conservative investments, and then maybe preferably best case scenario in the end you can even switch to bonds. So basically just to fix whatever you've made over your 30 years of investing journey, whatever you made, you don't want to lose 20% of it in literally 2 weeks. So you just switch to safer investments, you switch to bonds even better, and that's it. You will have less return, yes, most likely like nothing bad with such investments will happen, but just in case if something bad happens, you don't want to lose years of progress 2 weeks before the end of your investment journey, just when you're about to retire, and you lose like double digits of your portfolio. Not good. So for this reason, I am still value investor, but I am allowing growth companies in my portfolio because of long investment horizons, basically. And lastly, it's dividend investors. They prefer to invest in companies which are paying large and safe dividends, such things as like Dividend Aristocrats, Dividend Kings, like those companies which may not be part of those two categories, but which still have good and safe dividends for maybe like 10, 20 years. They've been paying good dividends. So these are the companies. For them, the important thing about those strategy is to invest in companies that paying big dividends and then to reinvest those dividends. So as you can see, so many different kinds of investors can tell you so many different answers to the question, what is a good investment? Okay, no questions, no joiners, so no participants, no new participants. Okay, so the first one, like I was talking about, is Dow Jones Industrial Average and Dividend Aristocrats. These are the companies. So Dow Jones Industrial Average is the DJIA, okay? It is the 30 biggest US companies, like Apple, Microsoft, Intel, IBM, I think, like Honeywell, I think, like all these kinds of big multinational corporations. And there's always must be 30 of them. So basically what it means, as soon as one company does not fulfill the requirements in order to be in Dow Jones Industrial Average index, this company is kicked out of Dow Jones Industrial Average and it is being replaced by another company. Or if another company outside of this index starts fulfilling the requirements to be included in this Dow Jones Industrial Average index, then one of the companies can be forcefully kicked out of this index and be replaced with the new company, but it always must be 30 companies. And Dividend Aristocrats, another category of good potential investments. These are the companies that are paying and increasing their dividends for at least 25 consecutive years. And dividend kings are the same companies which pay and increase dividends, but for this reason, in this case, 50 plus years. So these companies are relatively good investments. They might not be explosive companies, that they might not be growth companies, but like these are companies that have proven track record of having always excessive amounts of cash, so they can distribute and increase dividends every single year for 25 or even 50 plus years. So basically, if you do not know what to select, do not know how to select companies, these two places, Dow Jones Industrial Average and Dividend Aristocrats, can be a good starting point to start building your own watch list. And this is exactly how I started building mine. I literally took Dow Jones Industrial Average Index, 30 companies. I took Dividend Aristocrats. At that point, it was 66 companies. Now it's 65 companies. I combined those because some of the companies from Dow Jones Industrial, they are the same companies. They are also Dividend Aristocrats. So it's not 30 plus 65. I think it was like something around 85 companies. So this list, they overlap basically, okay? But that's not a big deal. So first I took just those two categories. Then I found for every single company on this list, I found their biggest competitors. So for example, if it's Coca-Cola, I took Pepsi, but I still think Pepsi is a Dow Jones Industrial Average, I'm not sure, but you get the idea. So I took one company from the list, from both of those lists, and I found its biggest competitors, and I added those companies to my own watch list. As a result, I started having maybe like around 150 or like 160 or even maybe 170 I think 170 companies just by doing so. And then I just literally started analyzing them one by one. This was the longest thing that took me to do, but this was the very beginning of my investing journey. So yes, I spent 3 days analyzing 170 plus companies, but it is better to start start on the right foot since the beginning, rather than to invest randomly in something and then later figure out like that you invested in some bad companies. So it's always better to spend just extra days in the beginning, prepare and invest in good companies since the beginning, rather than make adjustments later, like basically later, okay? So just if you do not have your watches, if you don't know where to invest, and if you want to invest in individual companies, this is a good starting point. Spend extra week or how long it's going to take you, build your perfect watch list, select perfect companies, and start investing in good companies since the beginning. Or if you cannot wait to start investing, just invest in index ETF. For example, the one that I did post about today, VTI, which is Total Stock Market Index. You invest in every single publicly traded company in the US, which is 3,590 companies. So you cannot go wrong with this. You invest in every single company. And while your money already working for you, then you can start researching individual companies. And then you might, if you want, switch from ETF to individual companies. Okay. No one joined, no questions. We continue because today topic is cool. Today topic is long. So today we do basically, as always, fast pace presentation. Okay, one of the first strategies that I've heard about, and it's, I guess, classic strategy, even though I never seen anyone using this strategy, but it's kind of famous in investing world, and it's called the dogs of the Dow. So it means, this is what this strategy means. The dogs of the Dow, it is 10 companies from Dow Jones Industrial Average Index that paid the highest dividends. Okay, the highest which have the highest dividend yield, I would even say, because highest dividends, like for example, one company can have dividend $1, but it's like, let's say, so $4 and its share price is $100. In this case, dividend yield is 4%. Another company can have dividend yield of $8, but like the share price is $800. So you think like, okay, this is so cool. Like this company pays 2 times more dividends, but because of share prices are like 4 times expensive, the dividend yield of this company is just 1%. So yeah, don't pay attention to high dividends, but pay attention to high dividend yield. The higher dividend yield, the more appropriate is the investment. And like I was saying previously, do not chase high dividends. But since we're speaking about Dow Jones Industrial Average Index, in this case, chasing high dividend yields, it's not that bad, let's say. So it's not the worst case scenario, okay? And don't worry, you will not see any crazy dividend yields in the Dow index, in Dow Jones Industrial Average Index. So there will be nothing like double digits, triple digits dividend yields. You will still see single digit dividend yields, which are still pretty conservative dividends. So what will happen? So you select Dow Jones Industrial Average Index companies, which is 30 of them. You find out the dividend yields of such companies, and you invest in those companies, in 10 companies, which have the highest dividend yield. And theoretically, this strategy works in the following way. Because of higher dividend yield, such companies have better chances of outperforming the rest 20 from the index. Very questionable strategy, in my opinion, but well, it exists. It's one of the earliest strategies, at least what I've heard. Like this strategy was, I think, mentioned in the Intelligent Investor book by Benjamin Graham. It was written like before any of us was born, and this strategy was already mentioned in this book. So it is old strategy, and if Benjamin Graham mentions this, so I guess there is some sense to it. But in my opinion, this is how it makes sense. High dividend yield means that share prices are lower than usual. So, and if the share prices are lower than usual and the company that has lower than usual share prices is from Dow Jones Industrial Average Index, which means it's a good, well-respected, well-known, big worldwide corporation. And if share prices are low, most likely this company will be able to survive through its difficult times, and it will recover, hopefully. Because if dividend is very low, if dividend yield is very low, it means that most likely share prices are very close to its all-time highs. And the opposite is true. If the dividend is low, it means that the share prices is far from its all-time highs, that there is a room for growth. And since we're speaking about Dow Jones Industrial Average Index, such companies most likely will recover, will bounce back, and will keep growing, and will continue basically growing. And like I said, they have better chance of outperforming the rest 20 companies. Once again, very questionable strategy. I do not use it personally because a lot of assumptions are made here, but just know that this strategy exists. And there are even ETFs for dogs of the Dow, literally ETFs. And every year you need to replace companies if necessary. For example, you have 10 companies in this year, And today, and in this year, like Caterpillar, for example, is a part of the dogs of the Dow. But next year, you see that Caterpillar share price came back, it bounced back. So now its dividend yield is not the highest. For example, now Boeing, I don't know, Boeing is not paying dividends now, but let's say, so theoretical example, next year, Boeing will start having higher dividend yield than Caterpillar. So you just replace Caterpillar with Boeing and just forget about your investments for another year. Just every single month contribute more, Dow Jones dollar cost averaging and stuff like this. But for now, that's it. Your portfolio management can be only done once per year. Or if you invest in ETF, they'll do it for you, so you don't even need to worry about. Okay, no one joined. No, I don't see any questions, I think. Let me see. No. Okay, so next one is you can invest. One of the good investments is investment in small, medium, and not popular companies. This is already more on growth investing side, but still, like, this strategy makes a lot of sense. And this is what I'm trying to research, trying to, let's say, so contribute more towards the strategy from my own, like from in my own personal investing journey, basically. So I am trying to invest in such companies which are small, medium, and not popular. Some of these companies could potentially bring you 2, 5, or even 10 times returns in long-term perspective. And yes, everything we'll be talking about here is investing. It's long-term perspective. So do not expect to invest in, I don't know, like Hertz or like Carnival, gets your quick gains in like a couple of months. And then if you don't get quick gains in a couple of months, you're like, okay, it was worthless investment. No, sometimes these companies, they take very long time to prove themselves, to be noticed, and to explode. So if you know that your company is strong, financially healthy, that has very good perspectives for the future, like just hold it, keep holding it, track it every single time there are new quarterly reports. Just analyze those reports. If everything is good, just keep holding them. The price might be very volatile in the beginning while they're still small, young, and undiscovered, but eventually they will get noticed if it's a company worth noticing, and your patience will be rewarded 100%. And why it can happen? Because small and medium companies, for them, it is easier to achieve double-digit growth. For example, Coca-Cola, okay? Coca-Cola has $35 billion in revenue last year, I think, if I'm not mistaken. So long story short, it's $35 billion in revenue per year. Okay, imagine what will take Coca-Cola to make it $70 billion. It is almost impossible for Coca-Cola to just simply double its revenue. Like, it's a lot. It's 35 billion to 70 billions. Something unimaginable must happen for Coca-Cola to do this. So most likely it will not happen. Like, it will happen eventually, but it will be happening slowly. 35 billion now, 36 billion next year, 40 billion 2 years from now, 45 billion 3 years from now, and so on and so on and so on. And eventually it might reach 70 billion. Yes, it will most likely do it. But over 1 year, it is almost impossible for such big companies to achieve double-digit growth, to double their revenues or anything like this. But when a company is small, when it just started, when it just became publicly traded company recently, and it has, let's say, so $3 million in revenues, for this company to make $3 million to $6 million, it is way easier than for Coca-Cola for 35 billions to 70 billions. So these companies, they can grow at double-digit rates, like 20, 30, 50% per year, 60% a year, and so on and so on. But such growth rates are hardly sustainable. You need to be extremely cautious investing in a company which is growing like 20, 30% per year. This growth rate is very hard to sustain. It may happen for 1, 2, 3, 4, 5 years, but then it will be harder and harder and harder. And investors will be very, very like scared to hold their positions in this company. As soon as growth becomes single digit, or as soon as growth becomes from 20% per year, becomes 15% per year, which is still mind-blowing growth, they'll be like, okay, the company is not growing that fast anymore. I'm going to pull my money out, and the stock price collapses. So be very cautious about investing in the companies with extremely big double-digit growth rates, and be specifically try to avoid as much as possible if the company you're investing in demonstrate 50% plus annual growth, basically, okay? These are the companies that most likely will not be able to repeat its success already in the next year, which means that that's it. Like investors will be just pull their money, lock in the profits, and that's it. And also not popular companies, what I'm talking about, these are the companies that are very easy to understand and simple business models. I don't know, like recycling, producing like plastic, like, I don't know, like producing pencils, pens, like something very monotonous, simple and easy. And because it is very easy to scale the production, just buy new factory, here you go, you have 10% more, how it's called, supply, 10% more revenue, like this and this and that. And boring names. So if you see something like, I don't know, like next gen technological XXX 6920, like company, next future Tesla, blah, blah, blah. Like this, the company just wants attention. It wants to grab the attention from the Wall Street, from its investors, invest in me, it's screaming. But like, no, these companies, they burn out. It's like investing is a marathon, not a sprint. You need to invest for the long term. These companies, yes, they might explode, they might, share prices might increase 50, 100% in 1 year, I don't know, but like that's it. This growth is hardly sustainable. Invest is something plain and simple and understandable, and this is one of the points of investing. You need to invest in a company which you understand. Like, for example, I understand Corsair, which I invested recently. It makes RAM, like, for example, mainly it's making RAM for computers, for laptops. Like, it's basically a PC, like technological company, okay? It makes its components. But I do not invest in, I don't know, like I don't know, biotechnology, for example, and stuff like this, like space exploration companies. I know, like these kind of things, because I do not know them. I do not want to research them. If I want to research them, there'll be complicated engineering terms, which I will not understand. So for me, I do not know if it's a good, if it's a bad thing. Invest in companies that you understand how they work and what they do. Okay, so next one is away from the Wall Street radar. Also very related and connected to the previous slide, that you need to invest in not popular small and medium companies. So first of all, you need to avoid buying companies when every rating agency assigns buy rating to such companies. And by the way, so whenever I'm every single morning, I am doing news summaries in our Instagram group. And also sometimes, well, lots of times, I also put like price targets and ratings of the company. You've seen it, yes? Like JP Morgan assigns buy rating to Tesla. No. JP Morgan assigns hold rating to Carnival. JP Morgan assigns sell rating to Southwest Airlines, like sell, buy, hold. You've seen those, like sometimes I put a lot of them. And this is the reason, basically. If you see that any particular company gets buy rating from almost every single rating agency, like Moody, S&P 500, JP Morgan, Wells Fargo, Scotiabank, like if every single rating agency assigns buy rating to this company, it is time to sell it. Hopefully, if you already have this company in your portfolio, you might think about locking in your profits, especially if the company's fundamentals changed in the bad way. Then, like I would say 90% consider selling this company. Like, but if you do not own this company, like for example, if you don't own Tesla, if you don't invest in Tesla yet, and then tomorrow, like every single rating agency will be saying buy. That's it. It's just definitely it's too late to buy already. And also the same thing goes in the opposite direction. If you see that rating agencies assign sell rating to companies, just take a look at this company, take a look at its financials, see if it's a good, if it's growing company. Like, and if the company has good financials, it might be a very good opportunity to buy some very undervalued companies. So this is the reason why I always say send this like buy, sell, and hold ratings in our Instagram group, in our Instagram Patreon group every single morning. Once again, if you see company being assigned buy ratings from everyone, if you have this company, take a look at its financials. If they're getting worse, consider selling. If they're the same, good. And if you want to hold this company for another 10, 20, 15 years, I would just say keep it. You never know when the price is going to go up or down. So like if you sell it, what if it just keeps going up? You never know. Just if you like the company, if you want to keep this company, if it's one of your favorite company, just keep it, like no matter what. Like, but if the financials are bad, then you can consider selling and then maybe buying later again when the price hopefully drops and the financials get better.
Right,
Institutional investors are also prohibited to invest in small companies. So according to Peter Lynch from the book that I was reading, One Up on Wall Street, very good book, suggesting you all read this book, like very, very good. So institutional investors, they cannot buy more than 10% of these companies, or they cannot invest more than 5% of their assets in one place. Institutional investors are basically big, large investors. We are regular investors, like people, basically, okay? But if it's an investment company with like billions of dollars under management, these are institutional investors, and they cannot buy more than 10% of one company, or they cannot spend more than 5% of their own money in one place. For this reason, sometimes, very frequently, small and medium companies, they're just out of reach for those companies. Like for example, like if it's a small company with market capitalization of like, I don't know, $50 million, for them, like $5 million, it's already 10%. And for some institutional investors, $5 million is so insignificant and low number that these deals are not even considered by senior and top management, because they have $1 billion deals, hundreds, dozens of millions of dollars they're investing. So for them, 5 million, it's like nothing. So they don't even waste their time analyzing where they should invest or not. They just skip those deals. And investment managers are prohibited from investing in such companies as well. So for example, think you're like a JP Morgan investment banker. You have your boss, investment manager, senior manager of investments or whatever, yes. And then you approach him and you say, okay, so I found this company, small company, very huge potential, like very big chance of exploding, but it's a small company, and your boss will most likely tell you like, it's too small, we don't invest in them, so forget about it. And that's it, you just cannot invest. So that's the reason why institutional investors and big whales of the Wall Street, they do not care about small companies with very, very big potential. And for you as an investor, individual investor, no one restricts you from investing in them. So you can find such companies early enough when they're still young and they still haven't proved themselves. But if you see that everything goes in the direction that will make them explode in the future, you just invest in them before Wall Street notices them, because as soon as Wall Street notices them, that's it. Every single institutional investor, every single investment company on Wall Street starts paying attention, starts investing in such companies. Its market capitalization skyrockets, your share price just goes to the space, and you have like, you can pocket 10, 20, 50 times gains. I don't know if possible. So this is the thing about finding such companies early in advance. And also investment managers from big companies, they cannot invest in such companies or even like medium-sized companies, because in order for the investment to be made, they are making list of companies that are safe to buy. So let's say, so there are 30 companies on this list, and see like, and how it's called, like younger, not senior, how it's called, like entry-level position, let's say. So I forgot the name. He or she drafted 30 companies list that he wants to buy. Then he goes, shows this list of safe to buy companies to his manager, and his manager then shows this list to another manager, then they show it to board of directors, to top executives, to senior management. So this list needs to be approved by like dozens of management, dozens of people on top. And these people, they're very busy. Obviously, they're not going to research every single 30 of these companies. And if they don't see companies that everyone talks about on Wall Street, they will just disapprove it. If they don't see, I don't know, Pfizer, Moderna, Tesla, I don't know, like Apple, Microsoft, and Johnson & Johnson and on this list, they'll just, I don't know this company, I don't trust it, don't invest in it. So that's as simple as that. So the investment is disapproved. So for this reason, this list, they always need to consist mainly like 90% of these lists, they need to have like well-known companies that everyone on Wall Street talks about. Once again, the reason why small companies are always out of reach for institutional investors and big whales on Wall Street. Okay. Not sure how much time is left. I think 5-10 minutes, but if I'm not mistaken, this is one of my last 2 slides, and I think we have a chance to finish this on time. I think I have maybe like less than 10 minutes. I think it's enough. Okay, no questions and no one joined, but we're almost done. Okay, next is one of my favorite type of investments, is recovering companies, and I've been talking about this already for quite some time. So you might already know what it means, Travis, but obviously I will talk about it again to refresh basically and to tell Gabriel what it means. So investing in recovering companies, this is what it means. You need to invest in big companies at this point, which are experiencing difficulties. And these investments, they can be a good idea. Why big companies in this case, not small ones? If a small company is experiencing financial problems, they can go bankrupt immediately, like within a week, within a month, definitely within a year. Just look at so many small businesses are closing left and right every single day, but almost none of the large corporations are closing because they can survive. So in this case, if you're investing in a recovering company, in this case, it is my honest recommendation to take a look at big already and established companies like Carnival, Southwest, cinemas, restaurants, hotels, cruise line companies, airline companies. This is what we're talking about at this moment, because these are the indices that are affected the most at this point. So, and like I said, target large and established companies in this case. And focus, when you're analyzing those companies, focus on chances of surviving for such companies, not growth opportunities in the future. So if you take a look at Carnival, which completely does not receive almost any revenue at all, except pre-orders and stuff like this, okay? Obviously, it's pointless to speak about their growth perspectives, like growth projections, anything like this. They'll just not get enough money. They're getting 5% of what they're used to get in the past. So it's absolutely pointless to speculate how much money they're going to be making in the future. At this point, it is better to focus on what's the chances of those companies to survive. So if we're speaking about cruise line companies, as always, take it company of interest and its main competitors. For example, Carnival, Royal Caribbean, and Norwegian Cruise Line. If it's airlines, it's Southwest, Delta, American Airlines, and like whatever this is, United Airlines, okay? And compare those companies between each other and see which ones of those companies has the best chance of surviving. And the best chance of surviving are usually represented by cash reserves and debt management. If the company has big cash reserves, literally it's money that's sitting on their checking accounts and basically do nothing. So, and these are the money during difficult times. These are the money that are used to keep paying salaries, to keep closing the deals, like mainly for salaries, let's say. So, okay. So if the company has good proportions of cash reserves, it means it can survive solely relying on its cash. It does not need to get any additional support or any additional orders of its services or products. It can just survive on whatever it already has reserved, whatever it already has in its like cash in its bank account, okay? So, and debt management, see if current liabilities are lower than current assets. For this, you need to take a look at current ratio, which is one of like a couple of presentations back, I think, that I was talking definitely about current ratio, quick ratio, and stuff like this. Don't have time to speak about this now, unfortunately. But long story short, if you see that current liabilities are far less than current assets, if there is like not too many, if debt to equity ratio is pretty low, if like just take a look at financials, okay? It will tell you everything from there. Don't take a look at income statement in this case, because once again, there's almost no income. It's pointless to look at revenues, net income, and stuff like this. But instead, take a look at balance sheet, quarterly balance sheet, not annual, but quarterly balance sheet, and see how the situation changes. For example, if you see that at previous quarter, there was, let's say, so $1 million in cash, and this time it's, let's say, so 800,000 in cash. So it means that in one quarter, in 3 months, they spent 20% of their cash, or $200,000. And that's it. You can absolutely, theoretically, more or less, like not precisely, but at least you can kind of estimate that just relying on its cash, the company can survive for at least 4 more quarters, which is like what, 1 year, almost 1 year and a half. And this is like almost for sure the time that they can survive for before even firing people or selling their ships if it's cruise line companies, or selling their planes if it's airline companies. And that's it. So focus on chances of surviving rather than growth opportunities. And as soon as such companies will start recovering, as soon as there will be no more ban on cruise ships, and I think there is no more ban anymore, it's just that the cruise line companies, they don't do cruises. It's their own initiative. They just want to be safe for now a little bit more. As soon as cruises come back, as soon as people start going back on cruises, revenues will be triple digits, like quadruple digits, maybe even thousands of percents of revenues, because instead of getting $10,000 per month, they'll be getting $1 million per month. And this is what it is like $1,000, 1,000 times more, 100 times more than original. It's 1,000% in revenue increase. And this is when the shares, at least are expecting to just explode. But holding such shares requires nerves of steel. Let's be family friendly here. So, and you just need to hold them. They're extremely volatile, very risky investments, but patience will be rewarded eventually, most likely as well. Okay, doesn't show me again, as always, for some reason, how much time is left, but this is the last one, very quick one. Hopefully it will not just end here. Where to get financial data from? Directly for a company's website. If it's Apple, for example, just type in Google, Apple Investors Relations or Apple Balance Sheet, Apple Income Statement. That's it, simple as that. Second place is Securities and Exchange Commission EDGAR database. Just once again, type in Google SEC EDGAR, and just then type in top right corner, if I'm not mistaken, company name, and look for 10K, 10Q, and 8K reports. 10K report is the annual financial report of a company, which has balance sheet, income statement, cash flow statement, commentary. It's 100 pages document, and it will have everything you need: qualitative analysis, quantitative analysis, anything you need. 10Q is the same as 10K, but it's quarterly report. So it will have, once again, balance sheet, income statement, cash flow statement, commentary, notes, anything that you need to know about the company, progress during one quarter. And 8K is the report when some significant event happened, like mergers and acquisitions, research, filing for bankruptcy. Whenever major events happen, companies need to file 8K reports, so you can basically see what's going on. Then you can get financial data from third-party websites such as Yahoo Finance, Macro Trends, MarketWatch, Morningstar, Wall Street Journal. There's dozens and hundreds of them. These are just my personal favorite, but I honestly use just Yahoo Finance 95% of the time. Everything that I need is there: balance sheet, income statement, cash flow statement, statistics, ratios, multipliers. All this is calculated for you. I don't need to calculate anything. I just need to analyze and interpret numbers. And obviously, the closer to the source, the more reliable is the information. So the most reliable information will be from the SEC EDGAR database or company's website, and least reliable will be third-party websites. But in my own experience, all these websites that I'm mentioning here, Yahoo Finance and stuff like this, all of them, they give you exactly the same information. So it's no point for them to cheat you, to fool you, to give you fake information. It's just no point for them. And basically that's it. I think I forgot my questions and answers slide, but I guess we just can keep my face. The rap battle, Eminem will be jealous of me, I think. So yes.
I learned some things, my friend.
I think I cannot hear you for some reason. Let me see why not.
Uh-oh. No
idea. Let me see. Okay, speaker. Okay, I think I can hear you now.
Right.
Yes.
Yeah?
Yes.
What's up? Hey. All right. So when you're talking about when everyone issues like a buy or overweight or hold these things, are there certain like issuers that you trust more than others? You know, because there's so many people, like, you know, Reuters will put out one, and then Bloomberg will put out one or whatever. There's all these different people who have them. Which ones do you like, or is there ones that you find to be more trustworthy than the other? Or I don't know. Does that make sense?
Yes, of course it makes sense.
Right.
For me, it's kind of also doesn't make sense for me to track those. And of course, the more famous is the company, the more trustworthy it is. Anyone can cheat. Like in the 2008 financial crisis, I think Moody's was responsible for like some kind of scandal because they were faking some reports, faking some recommendations and stuff like this. Anyone can cheat. But long story short, the bigger the company, the more resources they have, the more analytics they have, the more financial data they can absorb, the more financial data can to analyze it and summarize it. So the bigger the company, the more precise will be their analysis and recommendation. But basically, as you can see, like if one company recommends some company to buy, like let's say so Pinterest, almost every single other company will do just the same. So like if JP Morgan says Pinterest is a buy, Moody's will say it's a buy, S&P will say it's a buy, like almost everyone will just say it's a buy. So they always do almost the same kind of stuff. The only thing what they are different in is price targets. And price targets is basically a price that they think that the stock will be next year, 1 year from now, 12 months from now. And this is the place where they can be different. But their ratings, buy, hold, or sell, are almost always the same. And once again, being investor, these things almost do not matter to you because you just buy and hold, long story short.
Always.
Yes, once again, the only thing that can be useful for long-term investors for us, those ratings, like I said, if you have a company in your portfolio, which is, let's say, so I don't know, Pinterest, and then you see every single agency says buy Pinterest. Then you go on Yahoo Finance, see its financials. If you see that everything is good, yes, like most likely the price will inflate, then it will drop. But then if everything is good, it will start climbing back up again. Most likely in long-term perspective, everything will be good. But if you see that every single rating agency says buy, and then you see that the financial statements, revenues are declining, like current assets are falling, current liabilities are increasing, debt is out of control, there is no more free cash flow, operating cash flow is decreasing, then you might consider selling because agencies are recommending to buy, but fundamentals are decreasing. So long story short, what will happen in short term, most likely the price will go up, but eventually it will go down. So you need to buy when everyone says, you need to sell when everyone needs, you need to sell when everyone says to buy, but fundamentals go down. You need to sell basically when price goes up, but fundamentals go down. And you need to buy when price goes down, but fundamentals go up. So this is basically a basic principle of kind of successful kind of short-term investing or medium-term trading and stuff like this. But if you're just long-term investor, just don't care about those things. Like if you know your company is good, financially good, it has good plans, good perspectives, good future, like that's it. Like doesn't matter.
All right. And then Tuesday, are you busy on the 8th?
Am I busy on 8th?
Yeah.
I don't have anything yet, at least.
Well, Kathy and her team are doing their ARC webinar meeting.
Okay.
I didn't know if you want to go together. Like it's on Zoom, you know. I don't know if you wanted to sit in with me, and I know you're invested, so I usually like to catch the meeting since she has some of my money, you know. So
who is doing this, and what about this?
So right now, if you go on their Instagram, like on their stories, they're doing like you can ask them questions basically even right now. Mm-hmm. And so here, let me pull it up. But it's ARC Invest, you know, ARC KK?
Yes.
Yeah, so one second, let me pull it up on my Instagram right now. And I go to them, here, check this out. So there's Ask ARC next Tuesday at 1:30 Eastern time, which is I think 12:30 where I live. Our monthly market update webinar. Message us with any questions you have for the ARC team. So usually like Kathy comes on, she answers some of the questions. She brings in her analyst from like fintech and robotics and all these things. And it's just like they do I think they do monthly meetings and then quarterly ones as well and all that. And the quarterly ones are a little bit longer. I think they're like a couple hours, like 2 or 3 hours or something.
So it's basically ARC webinar.
Yeah, exactly.
Yeah, okay. I can take a look at this. Just send me the link or something on Instagram at least. Yeah, I can take a look.
Yeah, because I got some of their shares, and I know you do too, with the units of the ETF. So I'll send it over to you, and then we can both register or whatever, and we can watch it, and then maybe we could chat and after, like me and you can like be like, what'd you think about it? You know, like talk about what they were talking about. You know. So
like professional investors.
Yeah, well, I mean, just me and you kind of chat and see what I want to hear like your opinions on what she had to say and things like that. You know what I'm saying? So
okay.
Yeah, I'll send it to you.
Absolutely.
We can do that next week. All right.
Yes, absolutely. Yes.
Cool, man. Thank you so much.
Okay.
I had a good one.
Yes. Thank you for joining again. See you next week. See you next Tuesday already. Then have a good rest of the week. Bye.
Later, man.